So now let us start with SA 550, related parties. So in this particular standard, SA 550, the auditor's responsibility is mainly towards related party relationships and transactions while performing the audit of financial statements. So this particular standard is linked with SA 315, SA 330 and also SA 240. So SA 240 is not covered in CA intermediate, but this standard deals mainly with fraud. So basically, this standard mainly deals with how SA 315, 330 and 240 are applied on related party relationships and transactions. So in the topic audit risk from chapter 3, we have read about risks that require special audit consideration. And we have also read one important fact that two things are always significant risk. Fraud and related party relationships and transactions are always considered as significant risk. So that is what SA 315 deals with. Next, SA 330 deals with response to the assessed risk. So how are you responding to the significant related party transactions risk? So because related party relationships and transactions is a significant risk, how are you responding to that? And how is fraud? How is SA 240 applied on related party relationships and transactions? Are there any fraud going on between the related parties? So before understanding what is the meaning of related party, let us understand the difference between control and significance. So what is the meaning of control? In general sense, control means that what you will say will be done. What you say will be done. Your wish is my command. So whatever you are telling will be done. That is the meaning of control. What is the meaning of significant influence? Significant influence means that what you will say will be heard. There is no guarantee whether it will be done or not. What you will say will just be heard. So basically, control means that the entity can govern policies, the policies relating to financial and operating activities, and they can obtain benefit from these activities. So basically here, you can govern the policies. But in case of significant influence, you can only participate while the policies are being framed. While the financial and operating policies are being framed, you can just participate in them, but you cannot control them. So understanding this difference between control and significant influence is very important. Next, so what are the relationships that indicate presence of control or significant influence? First and foremost, significant relationship. First, if others have a direct or indirect equity holding or other financial interests in the entity, then there is an indication of the presence of control or significant relationship. If the entity has direct or indirect equity holding or other financial interest in others, then also there is a presence of control or significant relationship. Now, if the entity or if that other person is the part of TCWG or key management, if that other person is a part of TCWG or key management, then there's an indication that he has control or significant relationship. Now, if the close family members of TCWG or key management, if they are the close family members of TCWG or key management, then also there is an indication of control or significant relationship. When any party is engaging in significant relationship, business relationships between TCWG and key management, so it is basically in a significant business relationship between TCWG or key management, then in that case also there is an indication of control or significant relationship. Now let us come to the definition of related party. So related party has two definitions. First, as defined in applicable financial reporting framework. The definition as given by applicable financial reporting framework. But if the applicable financial reporting framework is not defining the related party, then the person or the other entity who has control or significant influence in the reporting enterprise, he'll be considered as a related party. So control can be either direct control or indirect control through one or more intermediaries. Or if the reporting enterprise has control or significant influence in another entity, then also it is a related party. Or if the another entity and the reporting entity both are under common control. Okay, so common control can be common controlling ownership or close family members. Both are having the same kind of close family members. Both key management is the same. Then in that case also it is a related party. However, under key management there is an exception. So what is the exception? If the entities that are under common control, the entities are other entity and reporting entity. If they both are under common control by a state, like a national, regional or local government, so the state is a key management, then in that case they are not considered as related unless they engage in significant transactions or share resources to a significant extent with each other. So they shall not be considered related unless and until the other entity and the reporting entity engage in significant transactions or they share resources to a significant extent with one another. So this was about the definition of related party as defined in applicable financial reporting. If applicable financial reporting framework does not define, then these three definitions by any definition. Okay. Now, let us understand the meaning of related party with dominant influence. So what is the meaning of dominant influence? If the related party has a dominant influence on the entity. So considering such dominant influence, considering such behavior is relevant for identifying and assessing risk of middle misstatement, especially due to fraud. So the dominant influence part is very, very important. So the auditor has to identify and assess risk of middle misstatement due to fraud. For that, he has to consider this dominant influence. Next, we have special purpose entities. So if there is any entity, the special purpose entity is specially made for a particular project. Now, if the entity is the related party of the special purpose entity, now this entity has a small percentage of holding in the special purpose entity, but still it will be considered as related party because in some circumstances special purpose entity may be a related party because the entity may in substance control it even if the entity owns little or none of the special purpose entity, because it may in substance control it. Next, we have related party relationships and transactions. Okay, what is the nature? First, if the nature is out of normal course of business, it is in normal course of business, then the risk of middle misstatement is low. So you are engaging with the related party in different transactions and they are in normal course of business, then it will be considered as, in that case the risk will be considered as low. So risk of middle misstatement is low. But you're engaging in transactions out of normal course of business, then in that case the risk of middle misstatement will be high. So what are the cases where the transactions are out of normal course of business and the risk of middle misstatement is high? First one is related parties may operate through an extensive and complex range of relationships. The relationships are complex and with a corresponding increase in complexity. The second case is information systems be ineffective at identifying or summarizing transactions and outstanding balances between an entity and its related parties. Party transactions may not be conducted under normal market terms. For example, some related party transactions may be conducted with no exchange of consideration. So in these three cases, the transaction is not a normal course of business and also the risk of middle misstatement is high. Next, understanding. So basically, the auditor will understand the entity's related party relationships and transactions. And in order to obtain that understanding, the auditor will inquire the management. Regarding what? So regarding these aspects, the auditor will inquire the management. First and foremost, he will check the identity of the related parties. Is it changing from the prior period? So in the prior period, if a particular party is a related party, is it still a related party in this period or are there any changes? So whether the identity of the related party is changing from prior period or not, the auditor will inquire with management. Second thing, what is the nature of relationship between the entity and the related party? The next inquiry will be this. The third inquiry is whatever transactions that you're entering into with the related party, what is the type of transaction and what is the purpose of the transaction? You have entered into transactions with related party, okay. What type of transaction is it and what is the purpose of the transaction? The third one is that the auditor will inquire with management and others within the entity. Mainly, first and foremost, he will inquire regarding the controls. So he'll obtain understanding of the controls that the management has established to identify, account for and disclose. IAD, you can remember it, acronym IAD. So basically, what controls did the management establish to identify, account for and disclose the related party relationships and transactions in accordance with applicable financial reporting framework? This is the first part. The second thing is that what controls did the management establish to authorize and approve significant transactions with related parties which are outside normal course of business? This second point. So if the management has established controls, then the auditor will obtain understanding regarding those controls. Which controls? First, what controls did the management establish for identifying, accounting and disclosing related party relationships and transactions which are in accordance with applicable financial reporting framework, and what controls which the management has established regarding authorization, approving significant transactions with related parties which are outside normal course of business. So once it has obtained understanding, once the auditor has obtained understanding, he will perform other appropriate risk assessment procedures. So this was about understanding. Next. So what are the records or documents which provide information about related party relationships and transactions? So the auditor has to stay especially alert while reviewing these records or documents which provide information about related party relationships and transactions. So the auditor can inspect documents, and what are the examples of those documents? He can inspect many kinds of documents. So some of the examples of those documents are, the first and foremost one is entities income tax returns. So the auditor can inspect the entities income tax returns. Next, the information supplied by the entity to regulatory authorities, and the documents associated with the entity's filings with the securities regulator. So 2 points are related with regulatory. Okay, so regulatory authorities like SEBI. Okay, so what is the information that is supplying to regulatory authorities, and what are the documents which are associated with the entities filing with securities regulator? Okay, like prospectus. Next, the statements of conflicts of interest from management and TCWG. So sometimes management and TCWG might have a conflict of interest. So what are the statements of conflicts of interest between TCWG and management? The next one is contracts and agreements with key management or TCWG. So are there any contracts and agreements with key management and TCWG? Next, significant contracts and agreements not in the entity's normal course of business. So those kind of contracts and agreements which are not in normal course of business. Significant contracts renegotiated by the entity. So are there any contracts which have been renegotiated during the period? Those kind of significant contracts. Next, specific invoices and correspondence from entities' professional advisors. So if the entity's professional advisors are giving any specific invoices and correspondence, then those documents. Next, we have internal auditors report, SA 610, the report given by internal auditor. Then shareholders registers, life insurance policies, shareholders registers to identify entity's principal shareholders, the life insurance policies which are acquired by the entity, the records of the entity's investments and those of its pension plans. So investments in the percentage of holding in subsidiary or associate or any other companies holding in this entity, what is the percentage? So basically the first 4 points are, the first one is income tax returns. The second 2 points are related to the regulatory authorities. Then statements of conflict of interest. So 2 points are related to key management and TCWG. The first one is statements of conflict of interest, then contracts and agreements. So there are 3 points related to contracts. Contracts and agreements with key management, contracts and agreements which are outside normal course of business, contracts and agreements which are renegotiated during the period, and specific invoices from entities' professional advisors. Then we have SA 610, internal auditors reports, shareholders registers, life insurance policies, and records of entities' investments. So this was about the documents which the auditor can inspect to identify related party relationships and transactions. Next, considerations specific to small entities. So where the auditor has to identify related party relationships and transactions, so it will differ with small entities and bigger entities. So in case of small entities, the internal control is informal. The owner interference is more in case of small entities. There are no formal internal controls. The owner's interference only is like an internal control. So basically there's a difference between small entities and big entities. And in case of small entities, the TCW does not include outsiders. The owner will become the manager. The owner and the manager are the same person in case of small entities. So the controls will be less formal, and there is no documented process to deal with related party relationships and transactions. So where the owner and manager are the same, where there is active involvement of the manager and the owner. So basically there is active involvement to main aspects of all transactions. So active involvement to mitigate the risk, and sometimes because of active involvement the risk may even potentially increase because of the active involvement. So for such small entities, what will the auditor do? The auditor will gain understanding on the related party relationships and transactions by management inquiry, by observation and oversight, and by document inspection. So basically he will directly inquire from the management, because management and TCWG is the same thing. He will do the observation and oversight, because it is a small entity. The oversight and observation will become easy for the auditor, and he will do the document inspection himself as well, because it is a small entity. The documents will also be less. So there are a few specific considerations in case of small entities which the auditor need to keep in mind. What are those specific considerations? He will understand related party relationships and transactions by management inquiry, by observation or oversight, and by document inspection. This can be asked in the form of an MCQ. So we're done with this standard.